Bismillahirrahmanirrahim. My dear students, Assalamu alaikum and welcome to all in my virtual class. I am Shahjalal Ahmed Pial, lecturer in Finance and Banking, Milestone College, Uttara. I hope all are fine and well by the grace of Almighty Allah. Dear students, let's start the class.
First, we discuss valued policy. The value of property to be insured is determined at the inception of the policy. In this policy, the value of the subject matter is agreed upon at the time of taking up the policy. These policies are generally issued for those goods or property whose value cannot be determined after their loss or damage. For example, pictures, works of art, jewelry, paintings, rare things, etc. The value policy is beneficial to the insured because he is relieved of providing the value of the property at the time of loss by searching for invoice and receipts. The disadvantages are that the new purchases and replacement cannot be added to the valued policy. Now, we'll discuss unvalued or open policy. An unvalued policy is a policy which does not specify the value of the subject matter insured, but is subject to the limit of the sum insured. An insurance policy for property that has a sum insured shown for each item, although the insurers do not acknowledge that this figure is its actual value. As a result, if a claim is made, the insured must provide proof of the value of the item lost, damaged, or stolen before a payment will be made. It leaves the insurable value to be ascertained by specified means in advance. This policy may have a maximum specified payment. Compare valued policy. Number 3, specific policy. Under this policy, the risk is insured for a specific sum, where a specific sum is insured upon a specific property in case of a specific period. The whole of the actual loss is payable provided it does not exceed the insured amount. In case of loss of property, the insurer will pay the loss if it is less than the specified amount. For example of a specific policy, an insurance policy is taken for taka 5 lakhs and the value of the property is taka 8 lakhs. If the property owed taka 4 lakhs is lost, the insured will give or get the whole amount of loss. If the loss is up to 5 lakhs, it will be paid in full. On the other hand, in case loss exceeds taka 5 lakhs, say it taka 6 lakhs, the indemnity will only be up to the amount insured taka 5 lakhs, not more than taka 5 lakhs. Average policy. The policy is containing an average clause called average policy. The amount of indemnity is determined concerning the value of property insured. The average clause is added to penalize the insured for taking up a policy for a lesser sum than the value of the property. The compensations payment is proportionately reduced if the value of the policy is less than the value of the property. For example, of an average insurance policy. Suppose a person takes up a fire insurance policy of taka 40,000 and the value of the property is taka 50,000. If there is a loss of property worth taka 20,000 and we determined the amount of claim by this formula. Insurance claim equal insured amount divided by value of the property into actual loss. Here, insured amount is taka 40,000 and value of the property is taka 50,000 and actual loss is taka 20,000. By calculation, we find out the amount of claims is taka 16,000. Floating policy. The floating policy is the policy taken to cover one or more kinds of goods at one time under one assured for an one premium and about the same owner. This policy is useful to those businessmen who are engaged in import and export of goods and the goods lay in warehouses at different places. The average rate of premium is ascertained by taking into account the total premium payable had the property been insured by specific policies. So, the flotation policy is a policy that covers loss by fire caused to property belonging to the same person but located at different places under a single sum and for one premium. Such a policy might cover goods laying in two warehouses at two different locations. This policy is always subject to average clause. Blanket policy. Blanket policy is issued to cover more than one named building or property or all the contents of more than one named building. Blanket policy as like floating policy, but difference some changes. Under such a policy, all the fixed and current assets of a manufacturer or a trade laying in different buildings can be covered by one policy at the same premium. So, a blanket insurance policy is a single property insurance policy that covers more than one type of property at the same location, the same kind of property at the multiple locations, or multiple kinds of property at two or more locations. It covers personal professions as well as the actual dealing, blanketing all the homeowners' professions. Number 7, excess policy. An excess policy is supplementary fire insurance policy which is purchased to cover additional risks beyond the coverage of original first loss policy. It is a very useful feature which can be considered by those people whose stock fluctuates from time to time. In this case, the first loss policy is bought for the minimum stock value and an additional excess policy is purchased to cover an anticipated fluctuation in the price of the stock. The actual value of the excess stock is declared every month. The amount of premium is calculated on the average monthly excess amount. Now we discuss comprehensive policy. A policy may be taken up to cover up all types of risk, including fire. A policy may be insured to cover risks like fire, explosions, lightning, burglary, riots, labor disturbances, etc. This is called a comprehensive policy or all-risk policy. This policy undertakes full protection not only against the risk of fire but combining within the risk against burglary, riots, civil commotions, theft, damage from the past, lightning. The policy is also named as all-in policies. It is known as comprehensive or an all-risk fire insurance policy. Number 9. Declaration policy. Under the declaration policy, the insured takes out insurance for the maximum amount that the considered would be at risk during the period of the policy. On a fixed date of every month or a specific period, the insured furnishes declaration of the amount. The premium is provisionally paid up to 75% of annual premium amount. The declaration must be made on a specific date or within the next 14 days. Otherwise, the sum insured will be deemed to be the declared value. The policy applies only to stocks and the sole property of the insured. The great advantage of this policy is that the premium is limited to the actual amount at risk, irrespective of the sum insured. The amount of the declaration offers scope for fraud because the insured may pay a lesser premium by undervaluing the stock. Therefore, this policy is issued only to reputed concern. In this case of declaration policy, since the excess premium is refundable at the end of the year, the insured may put fire to the property. Adjustable policy. In this policy, the insurance holder have to insure his finished goods in the actual amount of finished goods. The premium is fixed that amount of finished goods, and insurance holder has to pay the premium when the contract is formed. If the finished goods amount is increased or decreased, the insurance holder must inform the insurer and adjust the premium. Number 11. Maximum value of discount policy. The reduce the problem of declarable and adjustable policy. This kind of insurance policy are formed. Under this policy, no declaration or adjustment of policy is required, but the policy is taken for a maximum amount and the full premium is paid thereon. At the end of the year, in case of no loss, 1/3 of premium paid is returned to the policyholder. Number 12. Replacement policy. In this contract, the insurance holder gets the replacement amount of money from the insurer if the insured product is damaged fully or partly. This kind of policy called the replacement policy. This is also called the new lamp for the old policy. The policy provides a definite amount in case of purchase of new property in place of the old property destroyed. Number 13. Loss of profit policy or consequential loss insurance. This type of policy of fire insurance formed recently. Businessmen fall in loss by the fire accident because of his assets made damage by fire. That is why his business can be stopped. To reduce this kind of loss, businessmen can insure in an insurance company. So, my dear students, I hope all are understood the different types of fire insurance policies. Now, we also compare the types of fire insurance policy each another. Dear students, thanks to all with me. Stay with me and goodbye.